Hello everyone, a very good morning. Welcome to Oliveboard, and today we are starting with this series of CAIIB previous year paper discussions. So these series in this we are going to discuss such questions that are based on the June 2025 exam cycle, the questions that were asked in each of the shifts, and these are the must attempt questions before your exam. All right, so in this, we are going to discuss the important questions. All right, so let us start. What is going to be our agenda for this particular session or the other sessions in this series? We will practice the most important MCQs for the CAIIB BRBL December 2025 exam, and not just discussion of the MCQs. We will also revise the concepts. Along with the questions, along with the correct answers, I will also provide you with the explanation so that the whole concepts are revised. So this will be also helpful for your revision. And then you can also download the PDFs. Simply, how can you download the YouTube class PDF? You will open the Oliveboard app. Under this, you'll get this courses section. Under the courses section, scroll down and you will find the YouTube classes PDF. So every time that we have a class here, you'll get the PDF. Download these PDFs because not just the questions but also the explanations are important. Go through the PDFs, go through the explanations, and it will help you revise all the topics. So I think we are good to go and we should start with the first question. If you have seen the exam analysis of the June 2025 exam for the BRBL paper, some topics were repeated in all the three shifts, right? Like from the module A, there were questions that were repeated. Questions, there were like the case studies were there on mortgage, the banking director tenor was there, the Surface Act case study was there, how the sponsor bank works was there in the from the module A, the local area banks composition was there from module A. These things were there, the percentage of the stakeholders in the RRBs. Again, in the shift, second shift also, banking and regulatory acts were asked, the limitation act was asked. Like this, the topics were repeated. So, in this session, we'll be covering all the four modules in each of the sessions and maximum questions we'll be able to do. So, let us start with the first question for today. These questions are there from your module A. So, identify which of the following statements are correct. Banks must accept deposits only in the form of money, not valuables. Deposits accepted by the banks must always be repayable on demand. The KYC norms enable the government to open zero balance accounts. Under certain conditions, individual may be prohibited from using bank in their firm's name. So this is the most basic question. This question is there from the definition of banking as given in the Banking Regulation Act, Section 5B. What are the two necessary functions that the banking company has to perform? Acceptance of deposits from the public and lending or investment of such deposits. Deposits, however, read the statement, are not always repayable on demand. They can be withdrawable on demand or they will be repayable after a period of time. So we have the different types of deposits. But the deposit should be of money only, not anything else. This means that we are accepting deposits from the public in the form of money. But also, if let's say the person who is willing to open a deposit, they do not fall under the due diligence and they're not under the fit and proper criteria, the banker can also refuse to open the accounts for such undesirable person. Compliance of KYC norms, proper identification, these should be done. Okay, so here we can say statement 2 is incorrect, and if we exclude statement 2, then only option D remains. 1 and 4. So second and third statement is incorrect. 1 and 4 is true. All right. So this is how you need to solve these questions. You'll have to understand all the concepts. You'll have to remember these important things. Okay. Other important sections related to the acceptance of deposits, like under section 49A, no person other than a banking company, RBI, SBI, they can accept deposits withdrawable by check, right? Non-banking entities will be allowed under directions issued to them. License for banking is important under Section 22 of the Banking Regulation Act. And then they'll have to use the word bank, banker as a part of their name. No individual other than the licensed firm can use these terms. Permitted business, prohibited business, all of these things are there in the Banking Regulation Act. All right. Next question. As per the section 8 of the Act, which of the following instruments are not considered goods for the purpose of the trading prohibition? Okay, now let us first see the options. The options are furniture and bullion, actionable claims and shares, agricultural produce and bullion, specie and chattel. So, under the section 6 of the Banking Regulation Act, there are the permitted business. Apart from accepting deposits, giving loans, dealing in bills of exchange, drawing, accepting, buying or selling them, lending, advancing without security, guarantee, indemnity, all of these are the permitted business. However, the section 8 defines the prohibited business. A banking company cannot directly, indirectly engage in any trading activity. They cannot undertake the trading risk. Buying or selling or bartering of goods is strictly prohibited. But the definition of goods is important. Good means every kind of movable property other than money, bullion, specie, actionable claims, and stocks. All right, so here the correct answer will be option B. Actionable claims and shares, although they are movable, but they are not prohibited for the banks. All right, so this is the definition as given in the section 6.1 and the section 8. All right. Also, if let's say the any property still comes under the control of the bank, it has to be disposed of within a period of 7 years or extended period, whatever is provided to them. Okay, so the correct answer here is B. Now, in your BRBL paper, case studies are also very common. Case studies, scenario-based questions, statement type questions, these are asked by the institute, and the weightage is also increasing. So you need to have a good practice of the case studies and the scenario based questions as well. So let us see what is the scenario given to us. A private investment firm XYZ Capital starts accepting deposits from the customers that are withdrawable by check. Which of the following statements is correct regarding the legality of this action under the Banking Regulation Act? So we just read under the Banking Regulation Act, no banking company other than that is licensed will be allowed to accept deposits withdrawable by check. Right? Now, accordingly, let us look at the options. XYZ Capital can legally accept deposits if it registers under the NBSC framework. XYZ Capital cannot legally accept deposits withdrawable by check unless it is authorized by the central government. Any NBFC can automatically accept deposits withdrawable by check. The restriction only applies to firms and not to individuals. Okay, so under the section 49A, we had no entity other than the licensed banks, SBI and RBI, can accept deposits withdrawable by check until they are given special permission by central government. And this scenario, nowhere states at the XYZ capital had this permission. They were authorized by the central government. So they cannot legally accept deposits. All right, they cannot legally accept deposits that are withdrawable by check unless authorized by the central government. So this will not be valid. All right, okay. Next question. Which of the following are true as per the RBI Act and its amendments? Now, the module A basically covers two important acts, the Banking Regulation Act and the RBI Act. The various provisions of the two acts in relation to the regulation of the banking system, organization, management, board of directors, the supervision, the auditing, paid up capital requirement, everything is covered under these two acts. Okay, coming back to the question, which of the following are true? The Central Board of Directors includes nominees of the central government only from the local boards. RBI can replace the board of an NBFC under the 2019 amendment. The RBI gives the Act gives RBI the power to appoint the chairman of every scheduled bank. Section 19 defines businesses the RBI may not undertake. So, the Reserve Bank of India acts as the central bank regulator of the NBFCs, right? It was created under the Act of 1934 to take over the management of currency from the central government and for the carrying of business of banking in accordance with the provisions of the Act. So, regulating the issue of banknotes, ensuring monetary stability, keeping the reserves, operate the currency and the credit system. These are the responsibilities given to our central bank, right? Also, it is the regulator of the banks and other financial institutions like the NBFC. So, the power to issue directions, licensing, control over voting rights, quantum of shareholding, all of these powers are given to RBI. Amendment was made, the Department of Non-Banking Supervision was included. All right. So the correct answer here is option C, 2 and 4. RBI can replace the board of a NBFC and RBI has the power to appoint the chairperson of every scheduled bank. All right. So this is the correct answer. Let us see the explanation. The RBI Act has been amended from time to time. Latest amendment was to include the supervision over NBFCs. Government came up with the regulations to give more power to RBI. The Chapter 6 was included. The major changes, the net owned funds have been enhanced to rupees 100 crore. Different amounts of net owned funds may be notified. RBI has been provided ways to control the management of the regulating NBFC. They can replace the directors or they can also supersede the board. These are the powers given to RBI. Next, which of the following matters can an aggrieved banking company appeal to the central government against? Now, RBI is the regulator of the banks. However, the central government can also, in some cases, act as the regulator of a bank. These powers are given under the RBI Act, Section 7, subsection 1. So, some powers have been conferred to the central government to give directions to RBI wherever considered important in public interest and in consultation with the governor of RBI. But these powers are exceptional. These are to be rarely used. The only time they have been used, first and the only time where government gave directions to RBI was in October 2018. Separate letters were sent, right? The RBI governor, they received letters, directions on issues ranging from liquidity of the NBFCs, capital requirement for the weak banks, lending to SMEs. These issues were dealt with. All right. Other powers are also there with government. They can influence the RBI decisions. Let's say RBI has cancelled the license of the bank, or RBI has removed any director from the board, or RBI has imposed any restrictions on the banking company. They can make the appeal to the central government. All right. So, which of the matters can be appealed to the central government? Inclusion in the second schedule of the Act, cancellation of license, increase in CRR requirement, penalty for delay in annual financial inspection. So, if any of these decisions is taken by RBI, the banking company or the aggrieved person can make an appeal only in the case of cancellation of license. All right. So, a few areas where the power lies with the government are appeal against the removal of managerial personnel of the bank exercised by RBI, cancellation of banking license, refusal of certificate can also be made, suspension of operations, exemption from any provision of the BR Act, or any other matter, right? The central government also has the power to allow the banks to carry on any other business other than a banking company that can engage in. All right, so approval for the formation of subsidiary, then company giving them certain other business than the banking business, notification with reference to accounts and balance sheet, appointment of court liquidator. The government has powers to make rules in these areas as well. All right, so cancellation of license can be appealed to the central government. Let's move on. Under the Section 11 of the Banking Regulation Act, a foreign bank with a place of business in Mumbai and Kolkata must deposit with RBI. Now, for the carrying on of business, certain paid up capital and reserves requirement have to be maintained as are given in the Banking Regulation Act. So, what is the deposit to be maintained by the foreign bank if it has a place of business in both Mumbai and Kolkata? Rupees 10 lakhs, 15 lakhs, 20 lakhs, or rupees 25 lakhs. So, foreign company which is incorporated outside of India, operating in India, it has a branch in India, will have to deposit and keep deposited with RBI an amount of rupees 15 lakh. But if it has a place of business in Mumbai or Kolkata or both, then they will have to maintain rupees 20 lakh. So the correct answer will be C, rupees 20 lakh. Right? This amount will be kept in cash, unencumbered, approved security, partly or in both. Then, apart from this deposit, 20% of the profit also has to be deposited in respect of the business transacted through the branches in India, as they disclose in the profit and loss account, will be deposited with RBI. This will form the asset of the company, and on the cessation of business, it will be used. The creditors in India will have the first charge. All right, so these are the requirements of the foreign company. They're not required as such to maintain the paid up capital and reserve. They need to keep this deposit and the percentage of their profit with RBI. All right, so I hope this is clear. The paid up capital requirement of the Indian banks will be different. Their authorized capital, share capital, subscribed capital will be different. Now, this question relates to the Indian banks. A new domestic bank with only one branch may begin operations with as little as rupees 50,000 in the paid up capital and reserves under the old provision. A bank having its entire business in one state with no office in Mumbai or Kolkata is capped at rupees 5 lakhs maximum capital requirement. The distance clause treats any office within 25 miles within the same state as the principal place is there. and the RBI's capital norms override Section 11 for the SFBs through customized licensing policy. So, what is the correct answer here? Which of the following statements are correct? It is a lengthy question, but questions like this are asked by the institute. They're not asking direct MCQs with just four options. They'll be giving you statement type questions, scenario based, and case study. All right. So the minimum paid up capital and reserves for a banking company incorporated in India, if it has a place of business in more than one state, then yes, 5 lakh rupees will be there. Plus 10, plus if let's say any of the place of business is in Bombay or Calcutta, then 10 lakh rupees. So this statement is correct. Then if it has all the places of business in one state and it is not in Bombay or Calcutta, then 1 lakh rupees in respect of the principal place of business, right? And for every other place in the same district, it will have to maintain 10,000. Out of that district, 25,000. All right. Maximum, however, will be 5 lakh rupees, right? Okay, so these are the provisions regarding the paid up capital if it has a place of business in one state and that place of business is in Bombay or Calcutta, 5 lakh rupees plus 25,000 in respect of each place of business outside Bombay or Calcutta. Like this, they have to maintain, and accordingly, all the above statements are correct. All the above statements are true about the paid up capital and reserve requirement for the Indian banks. Now, do you remember the ratio of the paid up capital, subscribed capital, and the authorized capital? Paid up capital, subscribed capital, and the authorized capital. This was asked by the institute, right? So the Banking Regulation Act stipulates that the subscribed capital shall not be less than half of the authorized capital and the paid up capital shall not be less than half of the subscribed capital. So we have the ratio 4 is to 2 is to 1. 4 is to 2 is to 1. Okay. So authorized capital, if it is 4, the subscribed capital will be 2 and the paid up capital shall not be less than half of its subscribed capital. So 4 is to 2 is to 1. This ratio should be maintained. And if any time there's a imbalance in the ratio, then the requirement has to be complied with within a period of not exceeding 2 years. All right. Okay. Other important things are also there, like how the voting rights are determined, the board of directors are appointed, like this. Okay, next question. According to RBI's dividend declaration guidelines, a bank may declare dividends only if its gross NPA is below 5%, CRAR is 9% or higher for only the current year, it has a net NPO below 7%, CRAR more than or equal to 9% for 3 years. The net profit exists, CRAR is 9% for the preceding years and the current year as well. So, regarding the payment of dividend, which of the following statement is correct? So, the correct answer is D, right? The bank should have the CRAR of at least 9% for the preceding two completed years and net NPA less than 7%. Plus, whatever dividend is proposed to be paid will be paid out of the current year's net profit only. Right? So, the banking company should have net profit and only then they can declare the dividend, otherwise not. So, I hope this is clear. All right. Next, let's say if the bank does not have the CRAR norm, that is, they're not meeting the more than 9% norm, but having at least 9%, then if the net NPA is less than 5%, then also they will become eligible to declare the dividend. All right. Another case study. The government of India is considering issuing directions to the RBI regarding the emergency liquidity provisions for the struggling NBFCs. Which of the following conditions must be met? The directions must be issued after prior approval from the Parliament. The government can issue directions unilaterally without consulting any authority. The directions must be approved by the Central Board of RBI before implementation. The government must consult the governor of RBI before issuing such direction. So obviously the central government can give directions to RBI for the management, better management of the struggling NBFCs, but they do not have the unilateral authority. They must they must consult the governor of RBI before issuing such directions. All right, in consultation with the governor of RBI, the government of India can issue directions regarding the emergency liquidity provision for the struggling NBFCs. All right. So the correct answer will be D. Even the case studies, scenario based questions, they are based on the concepts itself, nothing out of it. So if you understand the concept, if you know the correct provisions, then you can easily answer the case studies. They're not tough. In fact, they're scoring. All right. So the correct answer is D. Next question. Who is not disqualified from being appointed as a director of the banking company? Now, the banking company can have whole-time directors, part-time directors, managing directors, but their appointment requires certain uh, directions to be followed. What are the qualifications of the whole-time director, chairman, managing director? These are very important points. The section 10B defines the whole-time or part-time director will be appointed from among the directors. On a whole-time basis, they will be given the entire management. Part-time basis, subject to the conditions imposed by RBI, and they have to be appointed with the prior approval of RBI. All right. However, certain individuals will be disqualified. Which of the following is not such criteria? A proprietor of a small scale industrial unit, a managing agent of a steel trading firm, an employee of a transport firm, or a 12% shareholder in a large FMGC group, fast moving consumer group. So, which of the following will not be disqualified to be appointed as a director of the banking company? Okay, so normal restrictions are there, like a person who has been adjudicated insolvent or has been suspended payment or involving moral turpitude, criminal misconduct, any person whose remuneration is in exceeding the share in profit, a person whose remuneration is excessive in opinion of RBI, they are ineligible. However, out of these, a person who is a proprietor of the SSI unit is not disqualified. All right. The section 10 completely deals with the tenure, the restrictions of employment, the appointment, the qualifications, right? Any person who has a special knowledge of the working of the company can be appointed, but they are the director of any company other than this one cannot be appointed as the chairperson. If they have a substantial interest in any other company, cannot be appointed. Like this, the qualifications are there and restrictions are there. Okay, and you need to understand them very carefully. Okay, other restrictions, which of the following is prohibited? under Section 20 of the Banking Regulation Act. Granting loans against bullion, granting loans to the government departments, granting overdrafts to the scheduled banks, granting loans on the bank's own shares as security. So there are restrictions on the loans and advances as imposed by the two acts. So what is the restriction? The correct answer will be D. Granting loans on the bank's own shares as security is prohibited. So, the Section 20 of the Banking Regulation Act imposes restrictions. No banking company shall grant loans or advances on the security of its own shares. They're also prohibited from entering into commitment on or on behalf of their directors, also giving loans to firms in which the director is interested as a partner, manager, employee is prohibited. A company in which the director has a substantial interest, they're acting as the director, manager, or employee, prohibited. If the director of the banking company is a guarantor, loan to those individuals is also barred, right? Director, any member on the board, managing director, advising director, they are responsible for all or any of the affairs. If they are in any manner involved in any of this type, they will be prohibited. Loans and advances cannot be granted to them. Okay. Identify the correct statements. Now, this is regarding the audit, scrutiny, and inspection. RBI can order a special audit for any specific transaction or period it deems necessary. Inspection teams may demand submission of internal memos or correspondence. RBI may inspect any bank branch even in the absence of a risk trigger. Our banks may refuse to comply with the inspection if they concern the third party accounts. So, the power to conduct the scrutiny inspection has been given to RBI. In certain cases, reports have to be submitted to central government. Banks are also required to publish their unaudited quarterly returns to the SBI. Talking about the powers given to RBI, right? Regarding the audits and auditors, the inspection that is to be conducted. The correct answer or the correct statements here are 1, 2, and 3 only. Banks cannot refuse if a direction is given by RBI, right? It will be binding. It is a statutory regulation, even if it clearly does not mention it to be statutory. All right, so the banks they cannot refuse to comply. It will be binding on the directions. Talking about the special audit, the section 30 empowers RBI to order a special audit when RBI is of the opinion that the audit is necessary in the public interest or in the interest of the depositors, right? All the transactions or a class of transaction for such period as specified by RBI. They can appoint a qualified auditor or they can tell the bank to conduct their own auditing. All right, it will be binding on the bank, they cannot refuse it. When the special audit is conducted, a report will be submitted to RBI and a copy will also be sent to the bank. So, in the special audit, the copy is to be sent to the bank. Otherwise, in the normal times, it is not necessary. Okay. Next, we have a question from the amalgamation, right? Amalgamation, mergers, winding up, acquisition of undertakings, again, very important. Okay, so identify the correct statements. A shareholder who dissents to the amalgamation has a right to exit with compensation if RBI sanctions the scheme. RBI must sanction an amalgamation even if the shareholders dissent, provided two-thirds support is obtained. Moratorium restricts the payment to depositors unless the government directs otherwise. The RBI has no power to recommend a moratorium without proper consultation with the High Court. So, regarding the amalgamation, what is amalgamation? It is sort of taking over, right? Two companies are amalgamated, a new entity is formed. That is amalgamation. Acquisition means taking of undertaking by the central government. That can be acquisition, they're acquiring. Amalgamation, one banking company can be amalgamated with another banking company. A scheme will be prepared, placed before the shareholders of the two companies separately, and it has to be passed by majority of the members representing two-thirds of the shareholders in each company. All right. Any shareholder who dissents, who do not want to be a part of the scheme, they can claim the value of their shares and they can exit. They need not be forcefully entered into the amalgamated company. Then, when the scheme that is prepared by RBI, it will be approved by the requisite majority. It will be submitted to RBI for sanction. Sanction will be done. Assets and liabilities of the amalgamated company will transfer to the banking company with which it is to be amalgamated. And the company which was amalgamated will stand dissolved. Right? So this new entity is formed. So the correct answer will be 1 and 3. Regarding the moratorium, RBI can send a notice to the High Court that moratorium should be given, holiday period should be given. However, consultation without prior approval of High Court, no such restriction is there. RBI can declare the moratorium if there appears to be a good reason. All right. The central government can also order the moratorium. Okay, and statement 2 is incorrect. If the shareholders dissent, amalgamation should not be sanctioned. All right, so the correct answer is A. Next, the shareholding structure of a typical RRB. This question was asked in the 2024 as well as in June 2025 cycle, right? The RRB's shareholding or the holding of the paid up capital. RRBs are established under the RRB Act of 1976. Earlier, it was the Ordinance of 1975, right? It will be established by the authority of central government in the area to be specified the particular local limits in which it will be functioning. It is sponsored, right? A sponsor bank is the bank by which the RRB is sponsored. The sponsor bank holds 35% of the issued capital of RRB. The central government holds 50% and remaining 15% can be held by the state government. All right, so this is the shareholding. So we have 35%, 50% and 15%. The correct answer is C. All right, the management will be given to the board of directors. They will function in the public interest. Okay, and the chairman will be appointed by the sponsor bank from among its officers in consultation with NABARD or the central government. What will be their business? For a particular area, small and marginal farmers, agricultural laborers, artisans, small entrepreneurs in the rural areas will be provided the banking services. Accounts and audits, same. It has to be submitted to the central government, and RRBs are now being amalgamated. Presently, there were around many RRBs were there when the act came into force. 25 RRBs were amalgamated into 10 in 2013. Then later on, many more amalgamations took place. There were 43 RRBs, and right now, as of 2025, another amendment was made, right? And the number of RRBs were reduced to 28. All right, currently the number of RRBs in India are 28. All right, which of the following entities is ineligible to apply for a payment bank license. Real sector cooperative owned and controlled by residents, public sector telecom provider, foreign fintech holding 40% stake in the PPI, resident NBFC with 5 plus years of operational track record. So the payment banks, they come under differentiated banks, right? Their how they are set up, what will be their functions, who are their eligible promoters, again important. What is the scope of activities of the payment banks? They accept demand deposits holding a maximum balance of 1 lakh per individual customer. It can be increased out, also 2 lakh is was the amendment made. They can issue ATM or debit cards, however they cannot issue credit cards. They can provide payment and remittance services. They can act as the business correspondent of another bank. Distribution of simple financial products like mutual fund, insurance product, right? Talking about the eligible promoters, existing non-bank prepaid payment instrument issuers, individuals, NBFCs, business correspondents, mobile telephone companies, supermarket chains, real sector cooperatives, and so on. All of them are eligible, but a foreign fintech holding 40% stake in the PPI will not be eligible. All right, the promoter group can also have a joint venture with an existing scheduled commercial bank. They can set up a payments bank, but the promoter or the promoter group should have fit and proper criteria. They should have professional experience running their business for at least a period of 5 years. Then they will be eligible to set up and act as the promoter of the payment bank. Then they will get the license. All right. Next question. Which of the following is true regarding the exemptions? Now we are talking about the registration. So, chit fund companies are exempt from registration under the RBI Act. Insurance companies registered with IRDAI still require a CRR account. The registration exemption extends to Nidhi companies. Mutual benefit companies and stock exchanges are entirely exempt from the registration requirement. All right. When any entity wants to get a license of NBFC, they have to apply it to RBI. However, there are certain exemption. If the particular entity is already regulated under any other apex institute, to obviate the dual regulations, certain categories of NBFCs that are regulated are exempted from the requirement of registration with RBI. Who are these entities? Venture capital, merchant banking companies, stockbroking companies registered with SEBI, insurance company, IRDA, Nidhi companies under the Companies Act, chit companies under the Chit Fund Act, HFB housing finance companies regulated by the National Housing Bank, stock exchange or mutual benefit company. So these institutes are already regulated by their regulators. So dual registration is not required. So the correct answer is 1 and 3. All right, another scenario. After acquiring Capital Line Bank, the central government decides not to retain the undertaking but directly vest it to Progressive Bank Limited, that is a public sector entity. What will be the status of the assets? Now, when acquiring a particular bank, the central government can either decide that all the assets, liabilities will be taken over by them, or they will be transferred to the transferee bank, So from the date of execution, the transferee bank will have both the assets and liabilities. So the Progressive Bank Limited will now have all the assets and liabilities that were earlier there with the transferor bank, the Capital Line Bank. All right. Okay. Next, Which activity based category always falls under the middle layer irrespective of the asset side? Now we are talking about the NBFCs. The scale based regulation of NBFCs is there. We have the base layer, middle layer, upper layer, and top layer. Which type of NBFCs will be there in which layer is very important. Like the base layer would comprise of the non-deposit taking NBFCs below the asset size of 1000, above the asset size of 1000 crores will go to the middle layer. Peer to peer lending, account aggregator, NOFHC, these all come in the base layer. Middle layer would consist of standalone primary dealers, CICs, HFCs, and so on. Upper layer, those requiring warranting enhanced regulatory requirement will be there in the upper layer. The top 10 eligible NBFCs on the basis of their asset size, irrespective of any other factor, will be in the upper layer. Top layer, however, will remain ideally empty. Only if RBI is of the opinion that there's substantial increase in the potential systematic risk, then from the upper layer, these NBFCs will be shifted to the top layer. Right? Coming back to the question, which NBFC will fall in the middle layer irrespective of their asset size? So the correct answer is NBFC, peer-to-peer lending platform. No, this answer is not true. The correct answer will be the infrastructure debt fund NBFC. The correct answer should be A. NBFC P2P falls under the base layer. All right, base layer. In the middle layer, we will have the standalone primary dealers, the infrastructure debt funds, CICs, housing finance companies, and the infrastructure finance company. Remaining three are there in the base layer NBFC. All right, so this is the correct answer. The correct answer will be A. Okay. Again, a case study. Express Remit Limited is an Indian agent operating under the Money Transfer Service Scheme. In 2024, the company underwent an internal audit that revealed irregularities in transaction monitoring and record maintenance. Upon inquiry, the director of the FIU found that the designated director had failed to ensure compliance under the provisions of the PMLA. The company had not reported the suspicious transaction. They had not implemented the reporting systems. So, the decision was taken against the director to initiate action. Which of the following actions can the director legally take against the Express Limited or its designated director? So now we are talking about the liability on the banking company and its directors for the non-compliance of the provision. So the correct answer here is B. They can impose a fine between 10,000 and 1 lakh for each issuance instance of non-compliance. So this is the penalty. The penalty which is imposed for the offenses. Let us discuss the penalties in brief. Penalties can be imposed under the RBI Act as well as the Banking Regulation Act. Under the RBI Act, Chapter 5 deals with the penalty of the violation of the Act. Like the banking companies have to furnish returns, statements, make applications, comply with the orders and directions of RBI. Failure to produce any book or account will be punishable with a fine up to 1 lakh for each offense, and continued offense rupees 5,000 for each day. Even the director or any person that was responsible for this will also be liable. Under the Banking Regulation Act, let's say a false statement is willfully made, any information is willfully omitted, material information is changed or removed, then 3 years imprisonment and a fine that can be extended to 1 crore or both. So these are the penalties under the two acts. Last question for today. Select the true statements. Corporation of stock exchanges brought in governance discipline and investor protection. Repo market expansion diverted volumes from the call money market. Government securities issued by RBI cannot be treated in the secondary market. RBI still participates in the primary government security market. Auctions as a standby buyer. So, which of the following statements are true? Basically, we are talking about the regulation of the various markets, the money market, the certificate of deposits, commercial papers. Till the mid 1980s, government was borrowing at the sub-market rate. But reforms were taken, concessionary financing was eliminated, ways and means advances was introduced. Like this, many amendments were made. The repo market expansion was also done to call the money market to increase the to for the diverted volumes. However, after these amendments, the government securities, the third statement will become incorrect. They can be treated, and the statement 4, the RBI now cannot participate in this market. All right. So these changes were made in the various markets. So the correct answer will be A. The whole description explanation is given to you. So make sure that you download the PDF by going on the Oliveboard app and go through all of these points for your revision. All right. Many reforms were there in the monetary policy, in the financial market, in the forex market, in the banking sector reforms that you need to study. So that is all for today. We have completed some of the important topics of Module A. Like this, we'll be bringing other sessions as well, and we'll be practicing the most important topics, the most important questions for your exam for the next cycle. All of these questions are based on the topics that were asked in the previous exam cycles, right? So make sure that you attend them. If you don't understand anything, obviously you can connect with me, you can comment down below. Now you can join the CAIIB Super Elite plan, which is the all-in-one plan. Why you should join this plan? Because you'll get 2000 plus live classes, 200 plus tests, special sessions on the previous year papers, summarized chapter wise notes. Even you will get access to the elective paper, doubt clearing session, peer mentor community. You can tag your mentor and ask any doubts if you have. So that is all for today. Your exams are very close, the registrations will start. Make sure that you start your preparation, right? With the limited time that you have in hand, complete the syllabus, start your revision, practice the mock test, and be consistent with your preparation. Like the video, share the video, subscribe to the YouTube channel because we'll be bringing these sessions for you every weekend, and these are very important for your preparation. So thank you so much. I will see you in the next session. All the best and have